Equity is a word that gets thrown around a lot in the property investing space, but do you actually know how to use it? More importantly, do you know how it's being misused to sometimes stunt your portfolio growth?
I have so many clients that still, to this day, will disregard where the money came from to facilitate the purchase. It's an important concept that people need to understand.
Jeremy Iannuzzelli, successful property investor and accountant to some of the wealthiest investors in the country, unpacks the rarely spoken about details of exactly how to use equity correctly, like a high-level property investor.
If you can make sure you get this part right, it sets you up to building a very successful property portfolio.
What do you need to ask your broker to make sure this happens?
You really need to make it very clear with what your goal is. I want to extract this equity and try to buy 2 properties off it. Cash flow is important because a lot of people get this wrong.
I should be doing this. It is just easy to overlook.
I'm going to say something which may disrupt a couple of people in certain industries, but I've seen it in the past and I still see it now.
If you want to understand how the dollars are found in the details, from extracting equity and using it to grow your portfolio, you're going to enjoy this episode. My name's Todd Sloan. This is the Pizza and Property Podcast, and this episode is powered by InvestorKit, PDN, and Property Strats. More about our awesome show sponsors in the show notes below. But right now, let's jump into the episode with Jeremy Iannuzzelli. Jeremy Iannuzzelli, how are you, man?
Always a pleasure, mate, and coming here to your lovely sunny town of Adelaide. It's fantastic to be in bright, sunny weather, especially after a long and rainy couple of weeks in Sydney. So I am ripped, ready and soaring to get into this today.
Love it, man. We're always happy to have you here, and especially to unpack the details of things that I think often get overlooked. Equity is a word that gets thrown around all the time. It's like, oh, just use equity. And it's like, oh, okay, cool. What is equity? How does it work? But more importantly, and this is why I specifically wanted to record this episode with you, how do people use it incorrectly? We're going to get into offsets, making sure it's in the right one. We're also going to talk about cash flow. There's a few different things we want to tick off with you, but can we actually kick it off with, for anyone that's totally new to property investing, real quick sort of 15-second high level, what is equity?
Yeah, so for everybody that's listening and any long-term listeners of your show that would have heard me talk about it quite a bit, and many professionals, whether it's brokers or buyers agents, talk about equity. So I promise, hang around because you will start to see some really juicy content of where equity does really well, what are the pitfalls of 100%. It, what are the failures. But in short, it's the difference between our valuation of an asset and our loan of the asset. And that difference is called equity. It's essentially what you have that meet in the deal. Mm-hmm. And then there's the difference of equity versus usable equity. And usable equity is actually, that difference between the valuation and the loan. Well, what can I actually use for my next investment, whether it's properties or other assets? So it's important to understand that when you've got an asset worth $1 million and a loan of $500,000, that 500 grand difference, million less 500, is our equity. Mm-hmm. And then we've got to go a little bit deeper into it and work out, well, what is our usable equity?
Can you expand on that now? Because most people would look at that and just go, well, I've got $500,000 equity.
Yeah. So I'm going to use my fancy little drawing pad in front of you at the moment. So if we've got our property here worth $1 million as a valuation and 500 grand as a loan, that difference of 500K, we call equity. And that's what I generally tell people what my net value is or how much equity I've got in a property. Mm-hmm. But then I need to understand, well, what is my usable equity? And I'll just call this UE. Well, in most particular circumstances, the bank will let you lend up to 80% in most circumstances, sometimes 90%, depending if you're doctors or you've got some special provisions.
Or if you're happy to pay LMI.
Or if you're happy to pay lender's mortgage insurance again. Now, remember, lender's mortgage insurance, for anyone that's listening, it's not just a one-off payment. You can continue to pay LMI throughout the ownership of that property, whether it's with the same bank or new banks. Mm-hmm. So you just need to be very careful about that. But let's say we're using 80% as our rule of thumb for today. That means that if we have an 80% leverage, we can have our loan being now $800,000 on a $1 million property. Therefore, we have $300K of usable equity that we can now put into more investments.
So, and that's because the bank still wants to see that there's always something left in the deal, just in case, whatever reason, they need that security.
Absolutely. Yep. Remember, the banks are a risk profile business, and it's all about making sure that there is enough meat on the bone for them. So if something does go down or something happens, they can sell it and they can get their money back in fairly quick time.
All right, so now we know the difference between equity and usable equity. It's almost like a bit of a net versus gross kind of thing. But talk to me about actually extracting equity, because I think that's something that is kind of said but not maybe detailedly understood of the best ways to do it.
The first part of doing it is actually speaking with your broker and getting an understanding of your borrowing capacity. A lot of people, and I see it within my client base, they've got loads of equity, very asset rich. Borrowing capacity, unfortunately, is not the greatest for them. Interest rates at 6.5%, 7% on some loan products make it very difficult. So there's a lot of lazy equity in their portfolio. There's a lot of money sitting on that tree, essentially, that they just can't pick. So that's where you really need to start to think about, well, you know, the equity that's there, if I can't use it, well, how good is it for me? So getting an understanding of that usable equity and being able to attain it's important. Speaking to the mortgage broker, getting an understanding of your borrowing capacity, and then unlocking it. And unlocking it will be going through the finance applications, getting all your pay slips in and your council rates and all the other stuff that comes with it, and then essentially releasing that equity from the loan, which means that now your loan goes up. You may have a split loan, and now anyone's listening, split loans are very important because you're now creating multiple loans secured against that one property.
Now, you've just touched on two really important things that I actually want to open up. The cash flow of it, because it is a loan, your loan's gone up, and the use of split loans. Which one do you want to dive into first?
I think cash flow is important because a lot of people get this wrong. But, you know, coming back to that split loan scenario, it's just creating that loan product, Todd. Moving forward to cash and understanding cost, I have so many clients that still, to this day, and investing for a long time, will disregard where the money came from to facilitate the purchase. All right, I want to lead you down a scenario of where very common, and we'll just again bear with me on my drawings. I try my very best, but
I like them.
I didn't do very well in visual arts at school all those years ago. But again, if we've got our property, and that property sits again with our $500,000 mortgage and against our $1 million valuation price, we've got our difference there of $500,000 of what they call equity. We've established that we do have our $300,000 equity portion here, which is what we've deemed now as usable, which is fantastic. So we now need to look at how we structure that equity portion. So how do we cut it up? Now, a lot of people will just cut it up in one split of $300,000, but then it becomes a little bit messy. So that loan structuring with your mortgage broker is very important. It's that financial engineering. So typically what I like to tell people is I'll say, guys, rather than having $300,000 as a one lump sum worth of equity that you extract, let's cut it into two lots of $150K. And that should suffice enough for our deposits of potentially two properties. So if we're looking now at breaking it up, essentially what we're doing is we're separating our original $500,000 mortgage and our new $300,000 split, which is now being sub-split, into two $150,000 amounts.
Okay, and explain why are we doing that?
So it's good from a visual perspective, from a cleanliness perspective of your loans. So now you've got an understanding to say, hey, I've got two amounts of loan worth $150 each, totaling the $300 equity that I drew out of the property, and I'm using that $150,000 for two purchases because that may have been your goal with the broker. I want to really now turn that into two more properties. 150 goes with property number 2, another 150 goes to property number 3, and that way when it comes to claiming the interest come tax time, you've got very clear segments of this is the interest that I'm paying on that equity for that property, which comes back to one of the main things where people miss when they're doing the calculations of the property's performance is they're never including that equity portion as part of the cost of the property, the ongoing cost of the property.
Got it.
So I just want to give everyone a bit of a visual perspective in detail what that is. So you've gone with your broker, you've got a good understanding of, I want to buy now two properties. I've split my $300,000 into two $150,000 amounts. Essentially what that's going to give me is the opportunity now to buy two more investments with that $150,000 worth of equity, totaling $300,000 that I've drew out of the original property.
So why not just use a big pool of $300,000?
Becomes really tricky over time. Then you need to start to subcategorize and prorata the interest of what money went to what property. How much was my deposit? How much was my legals and incidentals? How much was my stamp duty?
What have you used a bit for reno costs as well?
Could be renovation costs. All of a sudden, you're now starting to have to do spreadsheets on spreadsheets to prorata the interest on that whole $300,000.
Got it.
Where if we just subcategorize that 150 going to each of the properties, and again, bear with me for everybody watching of my beautiful lines, but if we subcategorize that 150 going to each of the properties, and we're using that facility only for that property to pay for renovation costs, incidentals and stamp duty, we've also got a very clean and structured loan, so we can identify quite clearly of what interest goes to what property.
So basically we're splitting it into the two different split loans. So that way it's clear as anything. There's no, oh, was that used for that? Was that used for that? Because otherwise, especially when there's a whole bunch of different decisions, you've then got to think back under like potentially years or a year of hundreds of different choices of where money went. Whereas if it's in these two different clean splits, it's just it went to A, it went to B. That's it.
That's it. It's all about the financial engineering and the loan structuring.
Before we get into the cash flow side of things, can you open up a little bit more about what do you need to ask your broker to make sure this happens? Because not all brokers will just kind of do this automatically.
And most don't. Most don't, because there's a bit more work involved for mortgage brokers. When I say most don't, that's a very unfair comment, but from what I'm seeing, especially from, early stage investors that haven't got, that little bit of financial knowledge or not savvy with lending or structuring and haven't spoken to professionals, they're just getting one big clump of 300 grand.
Yeah.
So you really need to make it very clear with what your goal is for your broker. Hey, I want to extract this equity and my goal is I want to try to buy 2 properties off it. The broker will tell you, yep, it's absolutely possible. We can do it. Therefore, hey, let's just split this nice and evenly into $150,000 amounts. You can go a bit deeper and say, hey, I want to try to buy 2 properties to the value, one of 500 and one of 700. And the broker can almost prorata the level of deposit that's required in incidentals against that $300,000 split. So that's a really good way to start the conversation. And then it's up to the broker to work through, and you'll hear me say it again a couple more times, the loan structuring and that financial engineering. So that long-term, Todd, and long-term for anybody that's listening, you've got now a very clean set of accounts. It's very important. It's telling a story.
Okay, so what if someone's listening to this going, I thought I should have done that, or even just I had no idea I should have done that. Can they retrospectively change a split, or is it like once it's done, it's done?
No, they definitely can. So that's the beauty. So depending on circumstances, you can actually go back to the same bank and split that loan. I've done it in many circumstances. Again, just for speed, I've been able to get things done quite quickly, and then I'll go back and clean it up with the mortgage broker.
Yep.
Or if you are going to a new bank, you're refinancing from bank A to bank B, part of the refinancing bank B is where you can start to create all the splits. So I'm going through a very, very big lending change at the moment with my own portfolio, moving a whole chunk of things from various different banks into Westpac, for argument's sake. And with Westpac, I'm actually going back and cleaning up some old splits in the past where I've had to use money from other splits to facilitate renovations on other properties. And I've kind of capitalized that now against the right property. So that way, moving forward in the future, the right loans are with the right properties. And that's happening as one big refinance with Westpac.
Right. So everything's changing for you, but you can go back like you've done and kind of look at it and go, actually, we need it this way now. But realistically, if you can just do it the way that you're wanting to purchase from the get-go, it's going to be easier for you.
Absolutely.
Yeah.
Absolutely. Okay. Now, I want to answer the question because we haven't touched upon the cash flow. And this is where people make the biggest mistake. So again, we might be buying a $750,000 property.
Yep.
And we might be getting, for instance, a loan of $600,000 to buy that particular property. Now, the $150,000 equity from our prior scenario, if we just look back here, we split our $150,000 times 2, totaling 300 grand.
Yep.
We've now used that $150,000 to buy a $750,000 property.
Okay, so just for ease sake, we're kind of negating closing costs on this one?
We're negating closing costs.
Yep.
We'll make it nice and simple.
Cool.
So the purchase price was $750,000 and the loan was $600,000.
Following?
We've used $150K of equity to fund the difference. Now, a lot of people, when they're calculating the interest on the actual property, they'll only calculate the interest on the $600,000. And it will show a position where, hey, this particular property might be only $5,000 or $6,000 or $7,000 negatively geared.
Yep.
Now, I'm going to say something which may disrupt a couple of people in certain industries, but I've seen it in the past and I still see it now. Buyers agents will not take into consideration, not all, but some, will not take into consideration where the deposit's coming from. So when the buyer's agent is sending through an Excel summary, they'll send through an Excel with the leverage of the property being 80%. And one of the main main things is that I'm asking the client, well, how are you funding the deposit? Are you funding the deposit through cash or equity? And most people will say, well, I'm funding the deposit through equity, whether they've drawn it from their own home or they've drawn it from another investment. Now, that makes the numbers on that Excel that potentially the buyer's agent or the property professional's given you
Totally wrong.
look much better
Yeah.
than what it really is.
They're incorrect.
They're incorrect.
Yeah.
Now, not their fault.
Yep.
I'm not going to throw them under the bus because it may be a question that they haven't asked the client, maybe something that the client hasn't given them, full transparency of.
And like you said, this isn't tarring an entire industry with the same brush.
No, absolutely not. But, I do still see it, especially, as people are looking for more cash flow orientated properties, numbers not being true and accurate. So once you start to include this equity portion that you're using to fund the deposit, all of a sudden there could be, in this particular case, another $7,500, $8,000 or $9,000 worth of interest, which needs to be included as part of the overall property's performance. That portion, that difference is the difference of seeing a property go from $6,000, $7,000 negatively geared all the way up to, say, $13,000, $14,000, $15,000 negatively geared. And I still see it today, not just from people buying with professionals, but most of the time buying in general, not including that cost of the equity.
I still remember, I reckon I was at rental number 3 before this actually clicked for me. And I was like, wait a second, I'm doing my cash flow at 80-20 for this. I should be doing this at 100%. What am I doing?
Absolutely.
Like it is just easy to overlook.
And common. And, we always try to make the numbers look as good as we can.
It feels better.
It feels better. I often will twist when I'm doing business plans or my own budgeting. I'll often twist numbers to say, oh no, I can bring it much lower than that. And quite often I can't. But visually at the end, I want to try to get the best result I can from my budget. So
and then you got to splash the cold water and go, no, wait a second, now let's fix this.
Yeah, you got to cool yourself down. Absolutely. It's an important concept that people need to understand, especially now in higher interest rate environments. And without a doubt, these interest rates have stayed much higher for longer than what I anticipated. I really thought, seeing a per capita recession that we saw in the 2024 calendar year, I thought we'd actually see interest rates come down the later half of the year. I really felt it. A lot of economists did as well. But, Michelle Bullock, she's kept it higher for longer, and the rhetoric is starting to be, more towards interest rates coming down. But I think anybody now can throw a dart and still miss the board quite easily.
It feels a bit like that. But as far as equity is concerned, high level overview, what is equity? It's the difference between the loan and the value. As far as what you should do when extracting equity, plan forward, make sure that if you're going to buy 1 property, 2, 3, whatever it is, talk to your broker about getting splits so it's nice and clean to keep track of. When you're actually assessing your cash flow, remember equity is debt. It's not just free money that you've been handed. And make sure you're doing your numbers accordingly to that. Is there anything that I've overlooked or anything you want to wrap this one up with, Jez?
No, I think that's really a good equity 101 from beginners to all the way to advanced. And I think once you really understand that concept, you get the financial engineering and the loan structure right. Finance is one of the key and biggest parts of any property investor's journey. It's the biggest part. The banks are the biggest stakeholder in your overall portfolio.
It kind of doesn't work without them.
It doesn't. So if you can make sure you get this part right and you do it really well, it sets you up for a much freer, much easier path to building a very successful property portfolio.
100%. Jeremy Iannuzzelli from Palladium Partners, thank you so much again for jumping on the show, man. I'm sure we'll see you again soon.
Always a pleasure, Todd. Thank you.